There is Nelco, which just, is jumping up like there is no tomorrow. We had the management of Nelco join us on Monday, just 2 days back, and they said the big opportunity, the game here, or I guess what the market is getting excited about is the fact that they're offering internet on airplanes. But that's only for international aircrafts passing over Indian skies. They say that the big opportunity is when domestic airlines will start to offer this, and they'll be in contention to provide those services. But that's 2 years away. So that's just what they told us 2 days back. 1,040 on Elco now. There is what else? Anantraj, which is up about 3%. Affle is starting about 1.5 higher. Lemon Tree is up about 2.7%. But I don't want to look at things with very little volumes. And there are a bunch of them at this point in time. On the downside, banks are seeing some cuts. Reliance is down about 2%. These are, banks and Reliance are the two areas which saw big moves on Tuesday, which kind of propelled things higher in a pretty significant way. And of course, IT is under pressure once again. There's nothing outsized in terms of specific stocks which is going on right now. So we'll, I guess, give it 10-15 minutes more and do a quick recheck. Our market master of the day is Ajay Srivastava. He's Chief Executive Officer at Dimensions Corporate Finance. Ajay, great to have you with us here. Thank you very much.
Good morning.
Will the mystery buyer, the big mystery buyer from Tuesday, show up once again, Ajay?
Well, you can ask for Santa Claus to come early.
What's going on? What are your thoughts on the market now, Ajay?
I think, I have never felt better in the market because this is a good market which gives you a chance to get in when you want to get in. It gives you a good chance to hold off and sit on the sidelines when you need to, and is not giving us too much of risk at this point of time, at least on the call, because of the purely demand supply of paper in the market. With the IPO drying up, it's all down to secondary market. So, in India, Prashant, the best part of Indian market is that at the end of the day, Indian market needs at least 1 lakh crores of paper every year, incremental. That's a demographic dividend that we have it. Whether insurance companies put together, mutual fund put together, EPF now, Provident Fund Trust put together, they need 1 lakh crore plus paper to come into the market. Now, if there is no IPOs of this magnitude, it has to be secondary market buying. And that gives you comfort that at least from the sales side, FPIs can sell, but domestically, the market is in need of fresh paper. And if there's no fresh paper, they will buy secondary market.
Ajay, good morning. Do you remember the movie Naam, which Sanjay Dutt and Kumar Gaurav? I think you would have seen it, right?
Yes, I heard. Yes.
In that movie, Paresh Rawal tells Sanjay Dutt, right, this is a one-way street. You can only come in, you can't go out. I'm saying this because this is the issue which FIs face, right? When they go out, you see the kind of price damage, but just to buy a trickle and the market's back to all-time high, so the impact cost is really high for them. But do you think there's something similar would play out once again?
Well, I wish Indian cinemas do better, my friend, because they're not doing well. So I think we need to get back some old movies. But yes, the answer is very clear. Now we are no more scared about FPI selling. We know for sure that when they sell and they sell big, you get a good chance to buy into the market. So I think that scare which we used to have, the FPIs can dictate the market and they are smarter than us. I don't think that's come out true. I think we as Indians and investors, we have been smarter in what we have been done with our investment profiles. When I look at my colleagues in the US, etc., I think we're doing better, and certainly we're doing much better than down in Japan, where the fund is down 40-50%. So I think there's no reason for us to believe, except the fact is all good things will come to an end, and these kind of Ps cannot rule forever. So whether our top-notch shares, you talk of Pidilite, you talk of Nestle, etc., they are like in absolute stratospheric level at this point of time. So so it can continue. How long it continues, we don't know. But the good part for India is we've got new sectors opening up. Whether the power sector has opened up beautifully is coming up, whether today there's a mining act may change and that segment may take a new lift off, absolutely. The hotels have come back with a vengeance, absolutely. So, so leave aside the old theories. The new players are coming, the new sectors are coming. So I wouldn't say it's a one-way street, But I would say it's a very one-way, very enjoyable and profitable street.
Okay.
The mid-cap index, by the way, is in the green already, and
Okay.
or has cut its losses, and the advanced decline is in the favor of advances.
Even for the market, it's not too bad, right? I mean, we were expecting, the SGX Nifty was suggesting about a 350-point cut, and you had said that, it won't be that bad, and it isn't. I mean, it's still down but not out, you'd have to say. Ajay, I didn't want to touch a nerve, but you brought it up, so I'm asking you about PVR because, the box office collections are sinking by the day, right? I mean, what's happening here? And as someone who's perhaps invested in PVR, tracks it closely, what do you do?
I think it's, PVR, unfortunately, Alex and PVR, I'm a holder, so for disclosure purposes, I did my bit. I have seen Maverick 3 times in the cinema, so I have done my bit. I hope you have done your bit as well. What can they do? They have got a software supply which resembles I'm sorry to use a political term, like a leading party of this country, which is hemmed in by families and friends and producing absolutely sub-quality output. And I don't think they can do very much about it. I think we just have hit a bad patch. They just need to find new places to get software from, or we will have a very troubled investment time in these stocks. Post-merger, I think you'll see some uplift coming in because the economies will start to come in and they will negotiate better deals. But no matter how big they are, they still can't get people to come in the cinemas if what's coming out of the Bollywood. So I think it's a good place to be. I think India has a great entertainment story still to come. We love to go out and no matter what OTT, how good it is. But I think they have reached a problem with software. I do not know whether my leading party in India will solve it first or Bollywood solve it first, but I hope it's a Bollywood for my sake.
For your financial sake. Ajay, so are you bullish, are you bearish? You're not giving us too much. Usually you stick your neck out. I mean, you're saying, well, let's ride this till it lasts. I don't know how long it lasts. And you usually are also slightly contrarian. When everyone is going completely one side, you take the other side. You're not doing that now. I mean, just to give you an example, I mean, just recent statistics, right? I mean, the market here is done extremely well. I mean, for the last, say, 4-5 days, I was just putting out data. The Nifty is up 1%. The S&P is down about, 6%, nearly 6%, 5.9 or something. You began by saying that we're not afraid of FI selling, etc. But does it really happen that way? We go one way and the rest of the world goes another? Maybe we'll all learn new lessons this time. But historically, it does not happen like that, right?
Well, it should not happen, but I think there's a major difference which is happening today. One, of course, I said demographically, we are accumulating more surpluses in our PF accounts, insurance accounts, than perhaps the Western economies. Certainly, Japan is not accumulating any surplus. They're using up surpluses. So to that extent, there is a clear flow difference. All right. The number two is, the fact still remains that the US is far more aggressive, given the fact that where the inflation is, they've never seen this kind of inflation. India is used to 7-8%. They're not used to this inflation. So they are far more rigorously going after inflation. And number two, they still haven't done what is the big trigger negative for the market is QT, quantitative tightening. That the big number has still not come to the table. The repo account equivalent is still surplus by almost $1 trillion as we talk today. Federal Reserve's got a surplus of $1 trillion as we talk today. So, therefore, there is a lot more damage that the Fed can do to the equity markets in the US at this point of time than perhaps the Indian central bank, which is, I would say, a little more tuned in with the political realities of India compared to the Federal Reserve of the US, which is a little more independent. And therefore, you find comfort that an India Reserve Bank has always been accommodative on the money supply policy. If that changes, a lot of dynamics can change the market. Still, you're not getting the FD rates, what you should be getting given the inflation, because RBI is giving a lease of line to the banks. If RBI adopts what Federal Reserve adopts, a lot may change and we'll become synchronous with the West. Today, we are not synchronous and we're not afraid because we have a little more benign stance by RBI, which has been very positive on liquidity compared to what we are seeing in US, where Federal Reserve has still to get the big bazooka out in terms of pulling out $150 billion a month out of the pipeline. So, that's a big difference. A benign Indian RBI versus a very aggressive Federal Reserve, and it is showing in the equity markets.
Auto stocks are really ruling the roost right now. I mean, expectedly so, right? We were just talking about waiting periods of almost 2 years for some of the new launches. But it's not just passenger vehicles. Tractors are coming back in a big way, heavy commercial vehicles as well. Are you invested here? And if yes, what would you like for the future?
We just moved out of it last week, Sonia. Completely, we have moved out of autos at this point of time. And I think the reason is very simple. that I think they're factoring in a lot more than what is possible in the market. I don't think we are, in our view, it may be wrong totally, market can surprise us. The point of interest rate coming in and kicking in and taking the demand out has still not factored in. It takes 4 or 5 months to come into the place. We have found better places to invest our money compared to incremental return that may or may not come in the auto space. And let me tell you something which I've seen historically, this long lines of 2 years disappear very fast. Quite a bit of this is speculative. Today, if you're going to buy a Thar, you pay 50,000 bucks extra dealer, he'll find you a booking to go into. So lots of this is speculative booking as well. One should not take it at the face value. No doubt they are in a good space at this point of time because there's a backlog of demand. But I still believe that the market, and market can be right and we can be wrong, that is not factoring in the high interest rate cost which is coming and sitting in the system and will start to play out in the last quarter of this year. I think the EMI cost is going to cut consumption, and we will find that autos will be one place where demand will be cut. It's not essential, it's not critical, and therefore our call has been to move out of auto as of last week rather than stay in the auto space.
You just look at the bank nifty, by the way, but it's clearly showing signs of buy on dips. In fact, from the lows, if you see the Nifty Bank, the low was 38,803, and that was the open as well. And from that point on, I think we are off almost 400 points off the lows. If we can get that graphic on the bank nifty, today is the weekly options expiry as well. And first thing in the morning, if people got short, I think it will be very interesting to see. So there's clearly a pickup from the lows. A buy on dips has been the thesis of this market. Now, Ajay, one space where we've seen some problems clearly is IT. At least in the US, clearly the Nasdaq stocks are retesting some of them their previous lows. In India, we're still way off the lows, but at higher level, clearly there's a bit of a struggle. Your views?
See, IT has a particular problem among all the sectors. It has the highest proportionate ownership of FPIs, has the lowest proportionate ownership of the domestic investors, and certainly very low in terms of HNIs and individuals. And therefore, they are quite susceptible to what happened in the global market. That's a one particular sector in India where the demand supply of stock comes into play very fast, because the moment the price goes up, the FPIs start to sell. And India, whether we like it, we like Infosys, we like TCS, the fact is retail ownership is low, institutional ownership is low, FPIs are over 40%. So what's happening in the US therefore translates more to the share price than perhaps the rest of the Indian economy. This is one sector totally exposed both on the demand side as well as on the investment side. And I think that will keep playing out, because at every opportunity, the FPIs will sell and will book profits whenever the stock goes up or the IT. So IT is a good place for people to retire the stock with, but is it a space for you to generate alpha returns? I doubt it, because 40% holding with FPIs comes to haunt us every time there is a price goes up of these stocks. So if the demand improves in the US, perhaps you can still be safer. But I think till US isn't where it is today, FPIs will be a big sellers in this, and there is not enough appetite domestically. So, just the demand supply of this stock takes over the fundamentals of why you should invest or not invest in the sector.
Two more sectors that I want to check with you, Ajay, which are doing exceptionally well. One is defense, right? I mean, names like HAL have doubled in the last 1 year. BEL is sitting at a fresh high. So is this a space that looks good to you? And the other is hotels. I mean, at the opposite end of the spectrum, but consumption is picking up in a big way as well. Do you like either of these sectors?
We're invested in both the sectors, to be honest. Okay, so that's for disclosure purposes. And the fact is that I think hotels will see a kind of profitability which they have never seen before in their lives. You just have to go through Booking.com or Expedia to know what's happening in this segment. And I think the top 2-3 chains will make superlative profits. What they made just now is nothing compared to what's coming in the October to December and Jan to March season. So it's a very clear buy and hold segment. Any correction means you need to get into a hotel business. And this is the first time. It's incredible, Sonia. First time in our history of investment where we have put such large money in hotels. I cannot believe we have done it, because we always used to hate the hotels, being capital intensive and so on. But I think the model of management contracts, supply shortfalls, and the urge to spend of Indians, and the K-shaped recovery of India, where the well-to-do are doing phenomenally well. Rack rates of 25,000 were unheard of. Today, people are paying 75,000 bucks a day for rooms. Man, it is the, I don't know. God has really been kind to that sector, and I think they'll make more money. So there's no question you got to be there. Defense, Government policy is very clear. The fixed returns to these companies are very clear. They give you a 7.5 to 12.5% return on every order, and all cost is passed through. What better business can you be? PSUs used to suffer because they could not pass through the cost back to the buyers at the end of the day, which was the retail public, whether fertilizer or banks, etc. This is one segment where the government guarantees that you execute the order, we will give you a 12.5%, or in case of Mazagon Dock, say 7.5% return. Now, it's a best business that you got to be local, you got to buy through them, easiest thing. PSUs get the order of priority, like Bell Electronics, for instance. You register with Bell and you can sell easily to the defense sector. You try doing it directly, you cannot do it easily. So the way these companies are set up, the only way to comfortably sell to defense is through these companies. And these will enjoy superlative profits again because cost is passed through. When you take the cost risk out of it, take a monopoly status, it can't get better for you, even though it's a PSU. When it privatizes, we will know it, but I don't think it will happen in my lifetime. But I think certainly sure that profitability-wise, it's guaranteed money on the table as far as these companies are concerned.
All right, Ajay, we'll leave it there today. Thanks a lot for joining us.
Thank you.
Okay, the market, by the way, just look at this. The mid-cap index is about to turn in the green. And, I spoke about Bajaj Finance and Finserv as perhaps the first go-to stocks if the market has to see recovery. And, just look at the way some of these stocks are moved. Clearly, there's a bit of a targeted buying in some of these financial names, especially from the FI side. And the first dip has been bought. Now, on days like today, you have to be wary of a second dip. Whether that happens or not, we'll find out. But at least we got the first hour low. And just look at the intraday recovery in all these